Most people don't fail at making money because they're lazy, stupid, or unlucky. They fail because they were taught the wrong story from the beginning. A story that sounds exciting, looks inspiring on screens, and collapses the moment real life applies pressure. The tragedy is not that people don't get rich. The tragedy is that they spend decades chasing an illusion while missing the slow, realistic paths that were available all along. Warren Buffett never chased those illusions. In fact, much of his life reads like the opposite of what modern money culture celebrates. No dramatic pivots, no viral moments, no secret tricks, just long stretches of boredom, self-doubt, missed opportunities, and decisions that looked unimpressive until decades later. This script is not about getting rich quickly. It's about learning how money actually works when time, reality, and human behavior are taken seriously. 1. The lie we're all sold about money. The first obstacle to making money is not a lack of skill, intelligence, or opportunity. It's a belief system. Long before people earn their first paycheck or make their first investment, they absorb a powerful idea about how money works. That idea is simple, seductive, and deeply misleading. That money comes from big moves, bold risks, and dramatic moments of action. We're taught that success looks like a breakthrough, a viral moment, a lucky break, a sudden leap forward that changes everything overnight. Movies celebrate it, social media amplifies it, news headlines package it as proof that anything is possible. But what rarely gets discussed is how unrepresentative these stories are, and how damaging they can be to people trying to build real, lasting wealth. Excitement is not the same thing as truth. Warren Buffett grew up surrounded by the same cultural noise, but he instinctively rejected it. Even as a child, he was less interested in dramatic outcomes and more obsessed with small, repeatable systems. While other kids fantasized about fame, adventure, or quick success, Buffett was reading about compound interest, tracking numbers, and running tiny businesses that earned a few dollars at a time. Paper routes, pinball machines, local services, none of it looked impressive, none of it felt cinematic, but it worked. The lie about money tells people to look for speed. Buffett looked for direction. The lie says money is about intelligence. Buffett learned early that temperament mattered more. Being smart didn't matter if emotions sabotaged decisions. The lie suggests risk is unavoidable. Buffett focused on avoiding mistakes before chasing gains. He understood that you don't need to swing hard if you can stay in the game long enough. This difference in thinking created a gap that widened over decades, not years. Modern culture makes this lie even more dangerous. Social media shows outcomes without timelines. Hustle culture glorifies exhaustion without questioning results. People are encouraged to grind relentlessly, even if the grind leads nowhere. Many work extremely hard and still make no progress because they're running in the wrong direction. They mistake movement for momentum. Buffett almost never made that mistake. Realistic money making starts with unlearning the fantasy. The fantasy says you need to do something extraordinary. Reality says you need to do something sustainable. The fantasy promises excitement. Reality demands patience. The fantasy is loud and visible. Reality is quiet and often boring. Buffett's entire career is proof that the quiet path works, even if it feels deeply uncomfortable for people who crave validation. For most people, this lie leads to constant restarting. New business ideas, new strategies, new investments, new plans every year. Nothing compounds because nothing lasts long enough. Buffett's advantage was not brilliance or secret knowledge. It was continuity. He stayed with ideas long enough for time to do the heavy lifting. Most people quit right before time becomes useful. 2. Warren Buffett didn't get rich the way you think. Ask the average person how Warren Buffett became rich, and you'll usually hear a simplified answer: investing, stocks, the market, smart picks. But this explanation hides more than it reveals. It makes Buffett's success sound like a technical trick rather than a long-term discipline. Buffett did not wake up wealthy. He did not stumble into a lucky trade that changed everything. His early years were slow, awkward, and financially unimpressive by modern standards. By today's internet-driven expectations, his progress would have looked like failure. Buffett made his first investments with amounts so small they wouldn't impress anyone now. He saved aggressively, lived modestly, and reinvested relentlessly. For decades, his lifestyle barely changed. No luxury cars, no extravagant homes, no visible signs of extreme success. If you judged him by appearances, you would never guess what he was building. This matters because most people don't quit when things go badly. They quit when things go quietly. When effort doesn't produce produce visible rewards, doubt creeps in. When progress can only be measured on spreadsheets instead of lifestyle upgrades, people assume something is wrong. Buffett endured years where his growth existed almost entirely on paper. He delayed gratification to a degree that feels unnatural in a world trained for instant feedback. And he wasn't alone. Small business owners slowly building customer trust follow the same pattern. Employees who steadily increase their skills while peers chase shortcuts often look behind for years. Investors who consistently add modest amounts instead of gambling on big wins rarely feel smart in the moment. These paths don't look impressive early on. They only make sense in hindsight. Buffett understood something fundamental that most people miss. Money is not a reward for effort. It's a reward for correct positioning over time. Effort without patience burns out. Patience without effort stagnates. Wealth forms where those two forces intersect. Another myth suggests Buffett was always winning. The truth is far messier. He spent years learning what not to do. He made mistakes. He missed opportunities. He underperformed the market at times. But his strategy was designed to survive mistakes. None of his errors destroyed him. This is one of the most overlooked principles in realistic money making. Survival matters more than brilliance. If you can avoid catastrophic losses, time becomes your ally. If one bad decision wipes you out, talent doesn't matter. Buffett optimized for staying power. He avoided leverage that could kill him. He avoided businesses he didn't understand. He avoided decisions that required being right all the time. Most people do the opposite. They chase strategies that only work if everything goes perfectly. When reality intervenes, as it always does, the plan collapses. Buffett didn't try to look smart. He tried to avoid being stupid. That mindset doesn't make headlines. It doesn't sell courses. It doesn't go viral, but over decades, it quietly compounds into something extraordinary. Buffett's story isn't about beating others. It's about outlasting them. While people jumped from trend to trend, he stayed put. While others optimized for excitement, he optimized for durability. While many tried to get rich fast, he focused on not getting poor. And in the long run, that made all the difference. 3. The years nobody talks about. Every success story has silent chapters that rarely make it into documentaries. Buffett's story is no different. There were long stretches where his investment partnerships delivered modest results. Periods where the market moved against him. Times when his cautious approach looked outdated compared to faster, riskier strategies. These years matter because they test belief. Anyone can stick to a plan when it's working. Very few can stick to it when it looks wrong. Buffett did. He resisted the pressure to change simply to keep up appearances. He didn't chase trends to avoid looking foolish. He accepted looking boring as the price of staying disciplined. In real life, these quiet years are where most people abandon realistic money paths. A business doesn't explode in its first year. A career doesn't transform overnight. Investments don't immediately outperform. The temptation to pivot, quit, or chase something flashier becomes overwhelming. Buffett's discipline was not glamorous. It was stubborn. General examples reinforce this. Many financially stable people didn't do anything dramatic. They saved consistently, avoided debt traps, increased income slowly, reinvested raises rather than upgrading lifestyles. Their stories don't sell courses or go viral, but they work. Buffett once said that the stock market is a device for transferring money from the impatient to the patient. This applies far beyond investing. Money flows toward those willing to endure boredom, uncertainty, and delayed feedback. The tragedy is that modern culture trains people to avoid exactly those conditions. The years nobody talks about are not failures. They are filters. They remove those chasing excitement and leave behind those building something durable. Buffett stayed when others left. That choice alone explains more of his success than any single investment. 4. Why realistic money feels uncomfortable. One of the main reasons realistic ways to make money are ignored is emotional discomfort. Slow progress creates anxiety. Modest wins feel insulting in a world obsessed with scale. Delayed rewards quietly attack self-worth, especially when others appear to be moving faster. Most people don't quit because something failed. They quit because something felt wrong emotionally. Warren Buffett was unusually comfortable with discomfort because he defined success internally rather than socially. He did not measure progress by applause, status, or visible milestones. He measured it by whether his decisions made sense according to principles he trusted. That internal measurement system insulated him from the emotional noise that ruins financial judgment. Most people measure progress by comparison, how fast others are moving, how impressive their results look, how exciting their story sounds. Buffett measured progress by alignment. Was the decision rational? Was it sustainable? Would it still make sense if no one ever noticed? That difference matters more than talent. In everyday life, this discomfort shows up as doubt. Doubt about whether saving small amounts is even worth the effort. Doubt about whether staying in a stable job means you lack ambition. Doubt about whether slow growth is just wasted time disguised as responsibility. These doubts don't arrive as clear warnings. They feel like intuition, and they quietly push people into unnecessary risks. Buffett's life demonstrates something counterintuitive. Discomfort is often a signal that you're doing something right. When progress feels boring, it usually means you're operating in reality rather than fantasy. When progress feels exciting, it's often because risk is being ignored, underestimated, or disguised. Realistic money making is not about eliminating discomfort. It's about choosing the right discomfort. Buffett chose patience over stress, discipline over anxiety, boredom over chaos. He accepted that the process would feel unsatisfying for long stretches because he trusted the direction. Over time, those emotionally uncomfortable choices compounded into extraordinary outcomes, not because they felt good, but because they were correct. 5. Losing money the slow way. One of the most misunderstood aspects of Warren Buffett's story is the belief that he avoided losses. He didn't. He avoided catastrophic losses. That distinction is everything. Buffett lost money many times throughout his career. What made the difference is how he lost it, slowly, in manageable amounts, in ways that taught him something instead of destroying him. Most people don't fail financially because they lose money once. They fail because one mistake wipes them out completely. Early in his career, Buffett made investments that contradicted his later philosophy. He chased cheap stocks simply because they looked undervalued on paper. Some of them were mediocre businesses with no lasting advantage. He made money on a few, he lost money on others, and slowly an uncomfortable realization set in. Buying something cheap is not the same as buying something good. That lesson cost him money, but not his future. This is where realistic money making diverges sharply from modern advice. Many systems today encourage all or nothing thinking. Go all in, bet big, take massive risks early. The logic sounds empowering. If you're young, you can afford to fail, but failure isn't just financial, it's psychological. A single major loss can permanently damage confidence, risk tolerance, and decision making. It teaches the wrong lessons. It makes people either reckless or frozen. Buffett understood that protecting psychological capital was just as important as protecting financial capital, so he structured his life so that no single decision could ruin him. He invested with margins of safety. He avoided debt when possible. He diversified when he didn't fully understand something. These habits don't prevent losses, they prevent disasters, and that difference compounds just as powerfully as gains do. In everyday life, this principle appears constantly. People take on massive debt to support lifestyles they haven't earned yet. They quit stable income for speculative ventures with no runway. They invest money they can't afford to lose because someone promised fast returns. When things go wrong, the damage isn't temporary. Recovery takes years, if it happens at all. Buffett's losses didn't end his journey because his system was designed to survive mistakes. He didn't confuse confidence with recklessness. He accepted that being wrong was part of the process. The key was staying wrong in small, survivable ways. Realistic money paths assume imperfection. They plan for error. They build buffers. They treat risk as something to manage, not something to impress others with. This mindset removes desperation. When survival is secured, decisions become calmer. Patience becomes possible. Long-term thinking stops feeling like a luxury and starts feeling like a strategy. Buffett didn't win because he never lost. He won because his losses never forced him to quit. 6. Why intelligence doesn't equal wealth. One of Warren Buffett's most uncomfortable truths is that intelligence has very little correlation with long-term wealth. This idea frustrates people because it challenges a deeply held belief that being smart guarantees success. Buffett spent his life surrounded by brilliant minds, and he watched many of them make terrible financial decisions. At the same time, he watched countless average individuals quietly build meaningful wealth. The difference was not IQ, it was behavior. Buffett consistently emphasized temperament over intellect, the ability to stay calm when others panic, the ability to wait when others rush, the ability to admit ignorance instead of pretending expertise. These traits don't show up on resumes or test scores, but they determine outcomes over decades. Highly intelligent people often struggle with money because intelligence creates overconfidence. They believe they can outthink the system, predict outcomes, or time markets. When they're wrong, they rationalize instead of correcting course. Buffett learned early that that humility is not a weakness, it's a financial asset. General examples make this clear. Some of the wealthiest people are not visionaries or geniuses. They are consistent. They repeat boring actions year after year. They avoid obvious mistakes. They don't chase status. They don't need to feel clever. They let time do the work. Meanwhile, many smart people sabotage themselves through complexity. They build elaborate plans instead of simple ones. They overanalyze and underact, or act too aggressively because they trust their reasoning more than reality. Buffett simplified wherever possible. Simplicity reduced emotional errors. Another overlooked factor is emotional regulation. Money decisions are rarely logical in real life. Fear, envy, pride, and impatience influence behavior far more than spreadsheets do. Buffett trained himself to recognize these emotions without obeying them. That skill alone separated him from millions of others. In practical terms, realistic money-making rewards people who can delay gratification, tolerate boredom, and accept slow progress. These traits are deeply uncomfortable in a world built around instant feedback and constant stimulation, but they compound more reliably than intelligence ever could. Buffett once said that investing is simple, but not easy. The same applies to making money realistically. The rules are straightforward. The execution is emotionally difficult. Intelligence helps you understand the rules. Temperament helps you follow them. For most people, improving financial outcomes doesn't require becoming smarter. It requires becoming steadier, acting less, reacting less, chasing less. Buffett mastered restraint. That mastery, not brilliance, explains most of his success. 7. The power of doing almost nothing. One of the most counterintuitive lessons from Warren Buffett's life is that his greatest financial advantage was inactivity, not laziness, not indifference, but deliberate restraint. While others felt compelled to constantly adjust, react, and optimize, Buffett learned that most action in the financial world is unnecessary and often harmful. Doing nothing when done intentionally became a form of discipline. Buffett has often joked that his favorite holding period is forever. On the surface, that sounds extreme, even naive, but it reflects a deeper understanding of how value actually compounds. The real work, Buffett believed, happens at the moment of decision. Once a sound decision is made, constant interference usually reduces its effectiveness rather than improving it. Most people misunderstand this. They believe success requires continuous activity. If something isn't working fast enough, they tweak it. If returns lag, they switch strategies. If progress stalls, they assume something is wrong. Action feels responsible. Stillness feels negligent. Buffett saw through this illusion early. He understood that overreaction is a hidden tax on returns. Every unnecessary action introduces friction, transaction costs, emotional bias, second guessing, and distraction. Over time, these small frictions quietly erode results. Not because the original idea was flawed, but because it was never left alone long enough to work. General examples make this painfully clear. Employees who constantly jump jobs for marginal pay increases often stall their long-term growth. Each move resets trust, learning curves, and compounding relationships. Investors who trade frequently underperform those who buy and wait even when they are intelligent and informed. Entrepreneurs who pivot endlessly never allow a business to stabilize or develop durable advantages. Action creates the illusion of control. In reality, it often creates instability. Doing almost nothing requires confidence in your framework. It means accepting short-term discomfort in exchange for long-term clarity. Buffett endured long stretches where his approach looked outdated, boring, or inferior. There were years when trend-driven investors outperformed him. He didn't respond by chasing what was popular. He responded by waiting. This kind of patience is emotionally exhausting because it offers no immediate validation. There are no quick wins to celebrate, no visible progress to share. For long periods, it can feel like nothing is happening at all, but something is happening. Time is doing the work. Compounding is operating quietly. The absence of action allows good decisions to mature instead of being interrupted. When results finally become visible, they appear dramatic, almost sudden. But what looks like overnight success is usually decades of disciplined inaction. Realistic money making is less about effort and more about restraint. Knowing when not to act protects capital, energy, and focus. Buffett didn't win by constantly making moves. He won by consistently avoiding bad ones. 8. Why most side hustles. quietly fail, side hustles are often marketed as the realistic path to financial freedom. They promise flexibility, independence, and extra income without sacrificing stability. Yet most side hustles fail quietly, without drama or closure. They don't explode. They don't crash. They simply fade away. Buffett's thinking helps explain why. Many side hustles are built on the same illusion as get-rich-quick schemes, just packaged more responsibly. The illusion is that effort should produce fast feedback. When that feedback doesn't arrive, motivation collapses. The core problem is misaligned expectations. People expect quick validation from systems that are inherently slow. They start something new and wait weeks or months for signs that it's working. When results are modest or invisible, doubt replaces patience. Effort becomes inconsistent. Attention drifts. Eventually, the project dies not because it couldn't work, but because it was never given enough time to mature. Buffett approached income generation differently. Even outside investing, he focused on businesses with durable advantages and long lifespans. He wasn't interested in novelty. He wanted reliability, predictability, systems that improved with time rather than decayed. Most side hustles fail because they depend on fragile foundations, trends, algorithms, attention cycles, or temporary demand. These forces change faster than the business can adapt. When the environment shifts, the hustle collapses. General examples reinforce this pattern. Online businesses dependent on platform algorithms, freelancing without differentiation or long-term clients, dropshipping models without brand loyalty. These approaches can work, but only when treated as long-term systems rather than quick income experiments. Another reason side hustles fail is divided attention. People underestimate the cognitive cost of juggling multiple priorities. They assume time is the only constraint. In reality, focus is the limiting factor. Each additional project drains mental energy, decision quality, and consistency. Buffett structured his life to minimize distraction. He read deeply, he thought slowly, he focused intensely on a small number of opportunities. Most people do the opposite. They scatter effort across multiple ideas, hoping one will break through. None receive enough sustained attention to compound. Realistic money-making requires choosing fewer things and sticking with them longer. Side hustles succeed when they become boring, when routines replace excitement, when systems replace motivation. Buffett's philosophy suggests something uncomfortable. If a hustle still feels exciting after the first year, it may not be stable enough to last. Excitement often signals dependence on novelty, not durability. Stability rarely feels thrilling. It feels repetitive, predictable, and sometimes dull. The real tragedy isn't that side hustles fail, it's that people interpret failure as personal inadequacy rather than structural impatience. They conclude they aren't disciplined enough, smart enough, or lucky enough, when the real issue was expectation mismatch. Buffett didn't abandon ideas because they were slow. He abandoned them only when they violated his principles. That distinction is crucial. Slow is not failure. Boring is not broken. In many cases, those are signs that something is finally real. 9. Time is the real currency. Most people grow up believing money is the ultimate resource. It's what buys freedom, security, and choice. Or so the story goes. Warren Buffett understood something subtler and far more powerful at a young age. Money is secondary. Time is the real currency. Money is simply one of the ways time reveals its value. This shift in perspective changes everything about how wealth is built, protected, and experienced. Money can be earned, lost, and earned again. Time only moves in one direction. Once it's spent, it's gone. Buffett didn't see wealth as a pile of dollars, but as a structure built to serve time, to preserve it, expand it, and protect it from being wasted. His entire investment philosophy reflects this awareness. He didn't just ask whether an investment would be profitable. He asked whether it would still make sense 10, 20, or 30 years later. Would it require constant monitoring? Would it depend on fragile trends, regulatory loopholes, or perfect timing? Would it demand emotional energy or stress? If the answer was yes, he usually passed. This long-term filter eliminated most opportunities automatically. Buffett wasn't overwhelmed by choices because time eliminated them for him. For ordinary people, this lesson is often missed. Many trade time for money without questioning the exchange rate. They work longer hours, chase higher pay, and add complexity to their lives, assuming money will eventually compensate for exhaustion. The problem is that money rarely repays pays time at a fair rate once health, clarity, and relationships are damaged. Buffett did the opposite. He protected his time aggressively, not because he was lazy, but because he understood that judgment deteriorates under pressure. Rushed decisions are usually bad decisions. Exhausted minds mistake urgency for importance. General examples make this difference clear. Two people can earn the same income and live very different financial lives. One feels constantly behind, stressed, and reactive. The other feels stable and in control. The difference is often not income, but time usage. One reinvests time into skills, systems, and assets that grow quietly. The other spends time reacting, consuming, comparing, or maintaining appearances. Buffett structured his life to maximize thinking time. He read obsessively. He avoided unnecessary meetings. He said no far more often than he said yes. He simplified decisions so that each choice didn't drain energy. This wasn't idleness. It was leverage. A few good decisions made with clarity over long periods outperform thousands of frantic actions. Realistic ways to make money prioritize time alignment. The goal is not to earn as much as possible this year, but to set conditions that improve outcomes every year after. Buffett's wealth appeared to explode late in life, not because he changed strategies, but because time was finally allowed to express itself fully. People underestimate how destructive impatience can be. They abandon good paths because progress feels slow. They sacrifice long-term stability for short-term relief. They confuse boredom with failure. Buffett accepted that meaningful results arrive late. That acceptance transformed time from an enemy into an ally. 10. The cost of chasing. One of the quiet tragedies Buffett observed throughout his life is how often people destroy financial progress by chasing more than they actually need. More income, more status, more excitement, more proof. What starts as ambition often turns into compulsion, and compulsion rarely leads anywhere good. Buffett lived modestly, not because he lacked access to luxury, but because he understood the hidden costs of excess. More possessions require more maintenance. More status invites more comparison. More income often brings more complexity. Each layer adds friction, obligation, and mental noise. None of this shows up on a balance sheet, but it shows up everywhere else. In real life, this pattern appears as lifestyle inflation. As income rises, expenses quietly follow. The new house requires new furniture. The new car brings higher insurance. The higher social circle brings expectations. What once felt like success becomes the new baseline. Satisfaction never arrives because the finish line keeps moving. Buffett avoided this trap by defining enough early. That decision changed everything because he knew what enough looked like. He didn't need to keep proving anything. He didn't need to optimize every outcome or squeeze every opportunity. He could wait. He could pass. He could ignore deals that didn't meet his standards. General examples reinforce how dangerous the chase can be. People who earn excellent incomes but feel perpetually behind. Entrepreneurs who scale businesses until they no longer control their own time. Investors who take unnecessary risks to beat benchmarks instead of meeting real needs. The original purpose gets lost. The chase becomes the goal. Chasing more creates urgency. Urgency creates pressure. Pressure degrades judgment. Buffett's restraint created freedom. Because he didn't need more, he wasn't forced into action. Because he wasn't forced, he could be selective. And because he was selective, his mistakes were survivable. Realistic money making includes knowing when to stop optimizing. Beyond a certain point, additional gains come with diminishing returns and rising risk. Buffett chose contentment over comparison. That choice protected not just his wealth, but his peace of mind. The irony is that those who chase less often end up with more. By avoiding unnecessary risks, distractions, and complexity, Buffett allowed compounding to operate uninterrupted. Most people interrupt their own progress by refusing to be satisfied. 11. What Buffett actually recommends for normal people. One of the most persistent misconceptions about Warren Buffett is that his advice only applies to professional investors or people with large amounts of capital. In reality, much of his guidance is specifically designed for normal people. People with jobs, families, limited time, and no interest in staring at financial screens all day. Buffett consistently emphasized simplicity because he understood where most people get hurt. Complexity. He rarely encouraged active stock picking for the average person. Instead, he pointed toward broad, low-cost index investing, steady saving, and long-term commitment. This advice disappointed those looking for excitement or shortcuts, but it reflected Buffett's deep understanding of human behavior. Most people are not wired to make frequent, high-stakes financial decisions without emotional interference. Fear, greed, overconfidence, and regret creep in. The more decisions required, the more likely something goes wrong. Buffett understood that discipline is easier when systems remove choice. Automatic investing, consistent contributions, minimal decision points. These systems don't maximize excitement, they maximize survival. His recommendations weren't about squeezing out the highest possible return, they were about maximizing the probability of success. General examples support this approach. People who steadily invest small amounts over long periods often outperform those who try to time markets. Employees who gradually increase savings as income grows build security without drastic lifestyle changes. Families who avoid unnecessary debt retain flexibility when crises arrive. Buffett also stressed living below your means, not as deprivation, but as leverage. When expenses are low, choices expand. Risk becomes optional rather than necessary. You don't have to accept bad jobs, bad deals, or bad stress just to survive. Many people underestimate how powerful financial breathing room can be. Another core principle was self-awareness. Buffett stayed within his circle of competence and encouraged others to do the same. He didn't pretend to understand everything. He avoided areas where uncertainty was high and confidence was artificial. Normal people often fail financially by copying strategies they don't truly understand, simply because someone else made them look easy. Realistic money-making, according to Buffett, is not about being exceptional. It's about avoiding obvious mistakes consistently, paying high fees, chasing hot tips, taking on unnecessary debt. These errors don't cause dramatic collapse. They quietly erode progress year after year. Avoiding them doesn't feel heroic. It doesn't produce exciting stories, but it works. Buffett's advice is unsatisfying precisely because it lacks drama. There's no adrenaline, no urgency, no illusion of genius, but that lack of drama is why it succeeds. It aligns with how people actually behave under pressure. It assumes imperfection and builds around it. In the end, Buffett didn't offer a secret formula. He offered a framework that respects time, limits ego, and favors survival. For most people, that's not just realistic, it's enough. 12. The tragedy of starting too late. Perhaps the most sobering theme in Buffett's reflections is regret. Not personal regret, but the regret he observes in others. Time lost to indecision, fear, or distraction is the one cost that cannot be recovered. Buffett often spoke about compounding as a simple mathematical concept, but emotionally, it represents missed years more than missed dollars. The tragedy of starting too late is not about age, it's about delay. People postpone action because they want certainty, confidence, or perfect conditions. By the time those arrive, the most powerful years for compounding are gone. Buffett started early not because he was wise, but because he was curious and willing to begin imperfectly. General examples echo this. People who wait to save until income feels sufficient, who delay investing until they understand it better, who postpone long-term planning because short-term demands feel urgent. These delays feel harmless in the moment. Over decades, they become devastating. Buffett's life shows how small early actions create massive late outcomes. The majority of his wealth was created in the later decades of his life, but only because foundations were laid early. Starting late forces people to take risks they wouldn't otherwise need to take. This doesn't mean it's ever too late to begin. It means the cost of delay is higher than most people realize. Buffett emphasized consistency over timing. Starting now, imperfectly, beats starting later with confidence. The emotional weight of this lesson is heavy because it can't be undone, but it can be learned from. Buffett's story is a reminder that time rewards action, not intention. Realistic ways to make money begin the moment someone accepts that waiting has a price. The quiet difference between wealth and money. One of the most important distinctions Warren Buffett internalized early, and that most people never fully grasp, is the difference between money and wealth. Money is visible, wealth is structural. Money shows up as income, purchases, and numbers on a screen. Wealth shows up as optionality, calm, and the absence of urgency. Buffett rarely talked about wealth in flashy terms. He spoke about freedom of choice, the ability to wait, the ability to say no, the ability to make decisions without desperation. These qualities don't appear on balance sheets, but they determine quality of life far more than income ever will. In modern culture, money is often treated as proof of worth. More money is assumed to mean more success, more intelligence, more value. Buffett rejected this framing. He watched people earn large sums and still live under constant constant pressure. He saw others earn modest incomes and live with remarkable stability. The difference wasn't earnings, it was structure. General examples make this painfully clear. Someone earning less but with low expenses, savings, and control over time often feels richer than someone earning more while drowning in obligations. Wealth is not what you make, it's what you keep, protect, and control. Buffett's realism shows that chasing income without building structure leads to fragility. One disruption, a job loss, a health issue, a market downturn can undo years of effort. Wealth, by contrast, absorbs shocks. It bends without breaking. This is why realistic ways to make money focus less on maximizing earnings and more on minimizing vulnerability. Buffett didn't build wealth by pushing harder. He built it by designing his life so fewer things could go wrong at once. The invisible skill that determines financial outcomes. There is a skill that determines financial outcomes more than income, intelligence, or opportunity, yet almost no one talks about it directly. Warren Buffett understood it early, practiced it quietly, and benefited from it for decades. That skill is self-honesty, not motivation, not ambition. The ability to see yourself clearly, without excuses and without fantasy. Most people fail financially because they build plans for an imaginary version of themselves. A version that is more disciplined, more patient, more rational, and more consistent than they actually are. Buffett never did this. He built his entire approach around his real temperament, not his ideal one. He knew he was patient. He knew he preferred simplicity. He knew he disliked complexity and emotional pressure. Instead of trying to change himself, he designed systems that rewarded those traits. This is one of the most realistic lessons in his life, and one of the most ignored. General examples make this painfully obvious. People choose careers that demand constant networking even though they hate social pressure. They start businesses that require non-stop hustle even though they burn out easily. They invest actively even though they panic during volatility. These aren't intelligence failures, they're self-awareness failures. Realistic ways to make money begin with accepting who you actually are, your energy levels, your risk tolerance, your attention span, your emotional triggers. Buffett never tried to become someone else. He doubled down on being himself. This is why copying other people's strategies often fails. What worked for someone else worked because it matched their temperament. When the same approach is applied by someone with different emotional wiring, it collapses under pressure. Buffett's strategy worked because it fit him perfectly. Self-honesty also applies to limits. Buffett stayed inside his circle of competence, not because he lacked curiosity, but because he respected reality. He didn't pretend to understand technology businesses he couldn't evaluate. He didn't invest in trends he couldn't explain. He knew ignorance was not a moral failure. It was a fact to be managed. Most people treat ignorance as something to hide. Buffett treated it as a boundary. This alone saved him from countless losses. In real life, people lose money not because they are unlucky, but because they refuse to admit what they don't know. Another layer of self-honesty is recognizing effort versus progress. Many people work extremely hard while avoiding the uncomfortable truth that their effort is misdirected. Buffett constantly evaluated whether his actions actually moved him closer to his goals. If they didn't, he stopped, even if those actions looked productive. General examples show how rare this is. People stay busy to avoid facing uncertainty. They grind to avoid reflection. They confuse exhaustion with effectiveness. Buffett did the opposite. He spent more time thinking than doing, because thinking prevented wasted effort. This self-honesty also protected Buffett from ego. He didn't need to be right publicly. He didn't need to defend bad decisions. When he was wrong, he adjusted quietly. Many people double down on mistakes because admitting error feels like failure. Buffett saw it as maintenance. Realistic money-making requires the humility to revise beliefs. Markets change. Careers evolve. Personal priorities shift. The ability to adapt without emotional attachment separates those who survive from those who cling to outdated identities. There is also an uncomfortable truth about discipline that Buffett embodied. Discipline is not about forcing yourself to do hard things. It's about structuring your environment so the right behavior happens automatically. Buffett didn't rely on willpower. He relied on systems. He avoided temptation rather than resisting it. He simplified choices rather than constantly evaluating them. He reduced decision frequency so each decision mattered more. This is realism in action. General examples reinforce this. Automatic savings savings work better than manual discipline. Low-friction habits outlast motivation. Clear rules outperform vague intentions. Buffett's success was not heroic, it was mechanical. Another invisible skill Buffett mastered was emotional delay. He didn't need immediate resolution. He could sit with uncertainty without acting. This ability is rare and valuable. Most people act prematurely because uncertainty feels uncomfortable. Buffett let uncertainty exist until clarity arrived. In modern life, uncertainty is often treated as a problem to eliminate. Buffett treated it as a condition to navigate. This difference explains why he avoided many mistakes others rushed into. Self-honesty also means recognizing when money is being used to solve non-financial problems. Buffett saw many people use money to chase status, validation, or security they lacked internally. These pursuits never end well. General examples show this clearly. Lifestyle upgrades that don't improve happiness. Career moves driven by comparison rather than alignment. Risk-taking fueled by envy rather than opportunity. Buffett didn't try to make money fix his identity. He built identity first. This is why realistic ways to make money often feel emotionally unsatisfying at first. They don't feed ego. They don't produce applause. They don't offer instant validation. Buffett accepted this trade-off because he valued long-term stability over short-term affirmation. There is also a moral dimension to self-honesty. Buffett believed in accountability, not in self-blame, but in ownership. When decisions failed, he examined them without excuse. This accountability sharpened judgment over time. Many people outsource responsibility to circumstances, the economy, the system, bad luck. While these factors matter, they become dangerous when they replace self-reflection. Buffett acknowledged external forces without surrendering agency. Realistic money-making balances realism with responsibility. It accepts constraints while working within them. It doesn't deny difficulty, but it doesn't use difficulty as an excuse for reckless behavior. Perhaps the most important outcome of self-honesty is peace. When your strategy matches who you are, tension disappears. Decisions feel lighter. Progress feels sustainable. Buffett's calm was not personality. It was alignment. Most people don't need better strategies. They need strategies that fit them. Buffett's life is a reminder that clarity beats intensity and alignment beats ambition. The invisible skill of self-honesty doesn't show up on spreadsheets, but it shapes every financial outcome. Ignore it, and even good plans fail. Embrace it, and even modest plans compound. Why boring is often a sign you're winning. One of the most uncomfortable truths about realistic money paths is how boring they feel when they're working. There is no constant stimulation, no dramatic feedback, no sense of momentum you can show others. Buffett accepted boredom as evidence of correctness. Modern systems train people to expect constant engagement, notifications, updates, milestones, validation. Financial progress doesn't work that way. Savings accounts don't feel exciting. Long-term investments don't provide daily thrills. Stable careers don't produce constant novelty. Buffett understood that boredom is the price of stability. When nothing feels urgent, it usually means systems are functioning as intended. People often misinterpret this calm as stagnation and sabotage it by introducing unnecessary change. General examples show this cycle repeatedly. Someone finally gets ahead financially, then upgrades lifestyle until pressure returns. A business stabilizes, then expands too fast and collapses. A portfolio grows steadily, then gets overtraded in search of excitement. Realistic money-making rewards those who can tolerate emotional flatness. Buffett didn't need constant reassurance. He trusted his process. That trust allowed compounding to continue uninterrupted. The tragedy is that many people abandon winning strategies because they don't feel rewarding in the moment. Buffett stayed because he understood that the reward arrives late and quietly. The role of luck, and why it should humble you, Buffett never denied the role of luck in his life. He acknowledged being born in the right country, at the right time, with the right temperament. This humility is often missing in money conversations, where success is framed as pure merit. Recognizing luck doesn't invalidate effort, it contextualizes it. Buffett worked hard, but he also knew that countless others worked just as hard without similar outcomes. This awareness made him cautious rather than arrogant. For realistic moneymakers, this perspective is grounding. It reduces entitlement and increases gratitude. It discourages reckless behavior fueled by the belief that success is guaranteed. General examples reinforce this. Two people follow similar paths with different results. One benefits from timing, connections, or external conditions. The other doesn't. Pretending outcomes are fully controllable leads to frustration and poor decisions. Buffett's realism includes accepting uncertainty. He didn't assume the future owed him anything. He prepared for randomness instead of denying it. That preparation made luck less decisive and mistakes less fatal. Understanding luck encourages conservative strategies. It pushes people to build margins of safety. It discourages overconfidence. These traits quietly increase survival odds over long periods. Why modern money culture works against you. One of the reasons Warren Buffett's ideas feel almost uncomfortable today is because modern money culture actively trains people to behave in the opposite way. Speed is rewarded, visibility is rewarded, confidence is rewarded even when it's disconnected from reality. Patience, humility, and restraint rarely receive attention because they don't perform well in public. Buffett built wealth in an environment that allowed quiet progress. Today, constant exposure to other people's apparent success creates pressure to move faster, earn more, and prove something. This pressure is not neutral. It pushes people toward decisions that look impressive, but are structurally weak. Social platforms collapse timelines. You see the highlight without the decades behind it. This creates distorted expectations about how money should behave. When your own progress doesn't match what you see, it feels like failure, even when you're actually on a healthy path. Buffett never compared himself to others in real time. That insulation protected his judgment. General examples show how destructive this comparison can be. People abandon stable careers because someone online claims to make more in a year than they will in a lifetime. Investors panic because markets don't move the way influencers predicted. Entrepreneurs chase scale before stability. The noise creates urgency where none is required. Buffett's realism rejects this urgency. He waited for clarity, not permission. He moved when conditions made sense, not when attention demanded it. In a culture built on constant reaction, this restraint feels radical. Modern money culture also blurs the line between income and identity. People begin to see earnings as proof of self-worth. Buffett avoided this trap. He didn't need money to validate him. That emotional independence gave him a massive advantage. Realistic ways to make money feel harder today, not because they stopped working, but because the environment changed around them. Distractions multiplied, attention fractured. Patience is tested constantly. The modern system rewards short-term thinking more aggressively than at any point in history, even when that thinking leads nowhere. Buffett's principles demand focus in a world designed to steal it. They demand calm in systems built on urgency. They demand long timelines in a culture obsessed with immediacy. This mismatch creates friction, but it also creates opportunity for those willing to endure it. Most people are not failing because they chose the wrong strategy. They're failing because they can't stay with any strategy long enough. The skill of staying, of remaining committed when results are quiet, has become rare. Buffett mastered it, and that mastery became a compounding advantage. Technology accelerated outcomes, but it didn't change fundamentals. Businesses still need customers. Investments still need time. Skills still require repetition. What changed is tolerance for delay. Buffett's realism restores that tolerance by grounding expectations in reality instead of hype. Another reason realism matters more today is instability. Economic cycles are faster. Careers are less linear. External shocks arrive with little warning. In this environment, aggressive bets may look appealing, but conservative foundations outperform over time. Buffett always prepared for volatility, not because he feared it, but because he respected it. Realistic money making today means building buffers, emergency savings that buy time, transferable skills that travel across industries, low fixed expenses that reduce pressure. None of these are exciting. None of them go viral, but they create resilience, and resilience compounds quietly. Buffett valued resilience over optimization. He wasn't trying to win every year. He was trying to survive every year. That perspective allowed time to work on his behalf instead of against him. The future will not reward those who move fastest. It will reward those who last longest. Buffett's life is proof that endurance beats intensity. The discipline of saying no. One of Warren Buffett's most underappreciated skills is his ability to say no, not occasionally, but consistently, to opportunities, to deals, to trends, to pressure. Saying no preserved his time, energy, and clarity. Most people underestimate how powerful refusal can be. Every yes creates obligation. Every obligation consumes consumes resources. Buffett understood that protecting focus mattered more than expanding reach. He declined countless opportunities that others would envy, not because they were bad, but because they weren't right. This discipline is difficult because saying yes feels like progress. Saying no feels like missing out. But Buffett recognized that most opportunities are distractions disguised as options. General examples highlight this difference. People accept promotions that damage their health, side projects that dilute focus, investments they don't fully understand. Each decision feels small and reasonable in isolation. Together they create overload, stress, and mediocre outcomes. Buffett's selectivity created space. Space to think, space to wait, space to respond rather than react. That space allowed deeper analysis and fewer but better decisions. This is a realistic path because it doesn't depend on constant success. It depends on avoiding obvious mistakes. Learning to say no requires confidence in your path. Buffett didn't need external validation. He trusted his framework. That trust took years to build, but once established, it became a powerful filter. Realistic money making is as much about subtraction as addition, removing distractions, removing unnecessary risks, removing comparison. Buffett mastered subtraction, and that quiet discipline multiplied his outcomes. The emotional side of money. Nobody prepares you for most conversations about money. Focus on numbers, strategies, and outcomes. Very few prepare people for how money actually feels over time. Warren Buffett understood that money is not just a financial tool, it's an emotional amplifier. Money magnifies existing traits rather than fixing them. If someone is anxious, more money often increases anxiety. If someone is impatient, more money amplifies impatience. Wealth doesn't cure emotional patterns, it exposes them. Buffett watched this dynamic play out repeatedly. People who believed money would bring peace often discovered it brought new pressures instead. Expectations rose, comparisons intensified, fear of loss replaced hope of gain. The psychological weight increased even as financial capacity expanded. Buffett avoided this trap by separating money from identity. Wealth was never meant to define him. It was meant to serve him. He lived in the same house for decades, kept routines simple, and avoided environments that encouraged comparison. These weren't quirks. They were protective measures. General examples make this emotional reality clear. People who reach financial milestones and feel strangely empty afterward. Those who earn more but sleep worse. Those who gain freedom on paper but lose it emotionally by tying self-worth to performance or income. Buffett designed his life so money reduced stress instead of increasing it. He valued predictability because it supported calm decision-making. Volatility may excite spectators, but it exhausts participants. Money decisions made from fear or ego rarely age well. Buffett waited until emotions settled before acting. This patience wasn't passive, it was protective. It prevented short-term feelings from hijacking long-term outcomes. The emotional discipline Buffett practiced is difficult because it requires self-awareness, recognizing when desire is driving a decision, noticing when comparison is influencing judgment, choosing restraint even when excess is possible. These skills are rarely taught, yet they determine financial satisfaction more than income ever will. In the end, Buffett's realism wasn't about becoming richer than everyone else. It was about staying grounded while the world tried to pull him into noise, urgency, and excess. That grounding is harder today, but it's also more valuable than ever. Why peace of mind is the ultimate return. If there is one metric Warren Buffett optimized for above all others, it was peace of mind. Not comfort, not luxury, not public recognition. Peace. The ability to wake up without financial dread. The ability to make decisions without panic. The ability to live without the constant background pressure that drains attention and energy. Buffett understood early that money is only useful to the extent that it reduces fear. When money increases anxiety instead of relieving it, something has gone wrong. Many people assume peace arrives after wealth. Buffett reversed the order. He built systems that protected peace first and allowed money to grow inside those systems. His lifestyle reflects this priority clearly. He did not surround himself with complexity. He lived in the same house for decades. He maintained routines that barely changed as his net worth grew. His calendar remained light. His environment stayed familiar. This simplicity wasn't a lack of ambition. It was a deliberate design choice. Complexity has a psychological cost. More moving parts mean more decisions, more maintenance, more uncertainty. Buffett removed unnecessary complexity because clarity is fragile. Once clarity is lost, even good opportunities become dangerous. General examples reinforce this truth. People with moderate incomes but stable lives often report higher satisfaction than those with extreme earnings and constant stress. Financial peace does not come from maximizing income. It comes from alignment between money, values, and lifestyle. Buffett aligned his money with his values early and rarely deviated. He didn't let rising wealth redefine what success meant to him. He defined success first and allowed money to serve it. Realistic money-making aims for sufficiency before expansion, enough savings to handle emergencies, enough income to avoid desperation, enough flexibility to say no. Once sufficiency is achieved, additional wealth produces diminishing emotional returns. More numbers do not automatically create more calm. Buffett understood this deeply. He stopped optimizing for money itself and focused on maintaining clarity, consistency, and enjoyment of the process. This mindset protected him from burnout and regret. He didn't feel chased by expectations, internal or external. The tragedy is that many people sacrifice peace in pursuit of money, only to discover later that money was supposed to buy peace in the first place. By the time they reach their goals, the habits that destroyed peace are already ingrained. Buffett reversed the sequence. He made peace non-negotiable. Money followed naturally, not because peace attracts wealth, but because peaceful systems make better decisions over long periods. The long view most people never take. One of Warren Buffett's greatest strengths was his ability to think in decades, not years, not quarters, decades. This long view stripped short-term noise of its power. Temporary setbacks lost their emotional charge. Trends came and went without influencing his core decisions. Most people say they want long-term stability, but live financially in the short term. They react to every fluctuation. They reassess constantly. They confuse motion with progress. Buffett committed fully to the long view, and that commitment simplified his decision-making dramatically. When time horizons are short, every outcome feels urgent. Every decision feels heavy. Every result feels personal. Gains bring relief. Losses bring fear. The emotional swings are sharp because the window is narrow. When time horizons are long, urgency fades. Individual outcomes lose their power. What matters is not what happened this month or this year, but whether the direction still makes sense. Warren Buffett didn't need to respond to everything because very little actually mattered in the long run. Most noise dissolves when viewed through decades instead of days. This mindset is rare, and general examples show why. During downturns, people panic. They sell not because their reasoning changed, but because their emotions did. During good years, they become euphoric. They take risks they would have avoided months earlier. Plans shift based on recent outcomes rather than underlying reality. Sound strategies are abandoned not because they stopped working, but because progress feels uneven. Buffett treated volatility as background noise. Markets moved. Economies shifted. Headlines screamed urgency. None of it altered his framework. He focused on process rather than outcomes. If the process was sound, temporary results were irrelevant. If the process was flawed, good results were a distraction. This distinction is critical. Outcomes are noisy. Processes are stable. Most people evaluate their decisions based on what happened recently. Buffett evaluated his decisions based on whether they were rational at the time they were made. That allowed him to remain calm while others reacted emotionally. Realistic money-making requires accepting uneven progress. Some years feel stagnant, others surprise you. There will be stretches where nothing seems to work, followed by periods where everything compounds at once. Buffett didn't demand consistency in results. He demanded consistency in behavior. That distinction protected him from self-doubt during slow periods and from overconfidence during good ones. The long view also reduces regret. When decisions are made with decades in mind, short-term mistakes lose their sting. Buffett didn't expect perfection. He expected endurance. He allowed himself to be wrong occasionally without questioning his entire approach. Errors were not identity threats. They were part of the landscape. This mindset removes the pressure to get everything right immediately. It creates psychological space. That space improves judgment, patience, and resilience. Without constant pressure to perform, decisions become clearer. You stop reacting and start responding. The long view is uncomfortable because it delays emotional rewards. There are no constant checkpoints, no immediate validation. Progress is often invisible for long stretches, but it is also liberating. It frees people from constant self-evaluation and comparison. You stop measuring yourself against yesterday's results and start measuring yourself against your principles. Buffett lived inside that freedom. He wasn't chasing moments. He wasn't chasing applause. He was building a life that could withstand time. In the end, Buffett's realism wasn't about beating markets or accumulating the largest fortune possible. It was about designing a system that allowed calm, clarity, and continuity to coexist. Money was a tool inside that system, not the point of it. That is why his approach still matters. Not because everyone wants to be rich, but because everyone wants peace. And peace, when protected consistently, compounds just like money does. Buffett's approach is simple to describe, but difficult to live. It requires patience, emotional discipline, and a willingness to let the quiet work of compounding unfold over years. It requires resisting the urge to chase shortcuts, hype, or immediate gratification. It requires understanding that your value is not measured by how quickly you move or how loudly your success is displayed, but by whether your systems endure, whether your wealth survives, and whether your decisions withstand the pressure of time. In the end, realistic money making is not just about dollars. It is about life. It is about the freedom to think clearly, act rationally, and sleep without worry. It is about protecting peace first and letting money follow. And that is why, when you look back decades from now, the progress will feel inevitable. Not because it was flashy, dramatic, or recognized by others, but because it was real. Because it was sustainable. Because it was aligned with what actually matters. That is the power of realistic money making. That is the quiet genius of Warren Buffett's life. What Warren Buffett's life ultimately shows us is not a shortcut, a secret trick, or a clever loophole. It shows us something far more uncomfortable and far more powerful. That building money realistically means accepting how the world actually works, not how we wish it worked. Most people aren't held back by a lack of effort. They're held back by impatience, comparison, and the constant pressure to prove something. Buffett escaped that trap by refusing to play a noisy game. He played a quiet one, a game where survival mattered more than speed, and consistency mattered more than excitement. If there's one takeaway from everything we've covered, it's this: boring is often a sign that you're winning. When progress feels slow, quiet, and almost invisible, that's usually when compounding is finally doing its job. The danger isn't moving too slowly. The danger is restarting too often. Realistic money isn't built by dramatic decisions. It's built by small, repeatable choices made over long periods of time. Saving when it feels pointless. Staying disciplined when no one is watching. Avoiding mistakes that don't look dangerous until years later. Buffett didn't succeed because he was smarter than everyone else. He succeeded because he stayed steady when others couldn't. And that's the part most people miss. You don't need to be exceptional. You need to be aligned. Aligned with your temperament. Aligned with time. Aligned with reality. If you stop chasing excitement, stop comparing timelines, and stop expecting fast feedback from slow systems, everything begins to change. Money stops feeling chaotic. Decisions feel calmer. Progress feels quieter, but more real. If you want to learn more, be sure to check out my other videos right here on the channel. I break things down step by step so you can take action, not just information. Thanks for watching More Money Tips. If you found this video helpful, please hit the like button, subscribe to the channel, and don't forget to tap that notification bell so you never miss a new video. I'll see you in the next one. Bye for now.